Good morning, everyone. I'm Vince Lancy. It's Monday, March 17th, St. Patrick's Day. Happy St. Patrick's Day to my fellow Irish brothers and sisters. Okay, 10-year yields are 429, down 3 almost. Dollars 103.52, down 20. S&P 500 is 56.24, up nothing. The VIX is 2212, up 34. Gold is 3,000 and roughly 30 cents, up 15. Silver is 33.80, down 3 cents. Copper is 488, up 5 cents. Interesting. WTI is 68.25, up 99. Natural gas is 424, 425, up 10. Bitcoin is 83.56, up 1,000. Palladium is 972, up 10 and change. Platinum is 999. Nice run there, up 5 since that UBS report, we would add. And there's fundamental reasons as well. Gold, silver, 88, now comfortably below 90, on the way to 75, let's hope. Soybeans, 1006, unchanged bid. Corn, 454, up 6. Wheat, 573, up 12. Okay, so just looking at this board for a second here. Two factors, domestic and Asian, right? I'm just going to focus on those two. There's more than two, right? Domestically, stocks had a very, very good Friday, up 2%. So big bounce off of a correction low, at least for now. And commodities are following suit. So you would make the case that if stocks are off the low and the dollar continues to weaken, then the markets are starting to think that a Fed cut is going to be coming again. So the markets are going from, oh, there's only one cut this year to, okay, we've dropped enough for the Fed to cut again. And the interesting thing about that from a commodity and gold perspective is if this is representative of the marketplace, and I'm not saying it is, then stocks are bouncing off the lows and commodities are bouncing off on change. So stocks have been selling off while commodities in general, oil not so much, but commodities in general have been stable in the stock sell-off. Gold has been actually higher. So you can make the case that if the domestic vibe, sorry that word propped up this weekend, vibe session, if the domestic vibe is that the Fed's going to possibly ease a little bit more aggressively this year for the remainder of the year, then commodities are outperforming stocks so far. Okay. The other thing is geopolitically. Look, China is going to do bazookas, a word that's been overused. China is now going to directly stimulate their consumers. The whole economy is housing related. Most economies are. And a China consumer with a house that's cratering and a mortgage that's underwater is very reticent to spend money. Okay. So that's been a big problem for them. It's ingrained in them after 10 years of this to be very careful with their spending. But over the last, I'd say, two stimulus events, China has, one, stabilized the housing market by guaranteeing mortgages, by lowering rates, by refinancing. And that has taken effect. Their housing has turned rather significantly. It's off the lows. It's not really high, but it's off the lows. Their commercial real estate is not the issue anymore. And that has begun to filter into the consumer area. And, China needs its domestic consumption to rise. And they're going to do that, just not on the US schedule, but it's happening right now. And so this latest stimulus comment, which came out yesterday or the day before, is that China is going to directly stimulate workers. The phrasing was they're going to get more pay. It described what can only be some version of helicopter money. They want consumers to feel comfortable spending, whereas we're trying to get our consumers to stop spending. All right, so there you go. That's the geopolitical reason. And if that happens, that's why copper goes up. That's why oil goes up. Well, oil's not really a big, uh, oil's too big for China to do that with. But silver, why is silver down given this? Well, you have to go with silver's being sold because someone's buying gold. Uh, or someone's been long gold and they're saying, I'm going to hedge it by selling silver. Not a bad idea. Or this is just one day. We think silver is on its way to $35 relatively soon. So silver is an all at once kind of commodity. And moving on to the topics today, we're going to be talking about a post that was put up on X over the weekend that got a lot of attention. So I think it's best to read that and fill in a little bit of detail because so we'll do that now. My microphone may be dropping in and out again. So let's see. Are we working? Yeah, we're working for the moment. News and analysis. These are the stories we put out since Friday, right? The top three, Gunlock Gold's going to reach 4,000. Now, he did an interview, a conversation with investors before gold hit 3,000 on Friday. So he's respected in the bond market, and that's unlocked for all. And it's also circulating in other areas like MarketWatch, but that's our original writing. Goldman, this is probably the most important story of the weekend for us. Here's why gold rallied last week. They put out a note on Friday describing that their upside target of 31 to 3,300 with a possible kicker of 3,500 at the end of the year is in jeopardy of being raised, or it's at risk of being too low. Hedge against collapse in real estates, in real rates, not real estates. Why does my microphone keep shifting? All right. There you go. Hartnett has a whole thing where he's talking about primarily the stock correction. Okay, but there's a small chunk that's devoted to gold as a hedge against real rates or further geopolitical unrest. Our podcast on that goes into the gold section extensively, as well as not giving short shrift to the stock portion. Gold tops 3,000. We project where it's headed. I'll tell you the numbers right now. The numbers are 3,600 and 42.85. Why? Well, that's projected. That's not predicted, meaning based on a measure of ETF flows coming into the market. If the ETF flows continue as they are and end up at a high as they were in 2022, February of 22, then gold will be at 3,600, no problem, or 42, depending on how we count it. Founders are serious worried about gold volatility. We're going to leave you with this, that gold volatility is no longer expected to outperform in a rally, unless, of course, it's a geopolitical scenario. All right. Moving on to the actual story. There's the front page. The story on X, well, the post on X we just put together was kind of like a dot connecting moment for us. So we shared it there, and we'll just share it again here with a little bit proper connection. Over the last 30 years, bullion banks have been leasing gold from central banks. So it's been happening for decades. That's point one. James Rickards' books corroborate this. The New Case for Gold, he has a chapter that discusses this that people just kind of ignore, but they shouldn't. In point two, we said that Chinese physical demand has made it a little bit harder. A little bit's a euphemism. It's probably a lot of it harder to get gold for leasing. And stress began to form in that. That would be Zoltan's crisis of collateral. Point three was the US government. Now, this is where we start to have some conjecture here. The US government seeing this and knowing that it had extensive IOUs on its own gold, it did, along with Moths in pick two, that's the pick right there, sitting in Fort Knox, either began calling their IOUs back or US bullion banks, seeing the collateral was scarce, started securing gold to satisfy their own Fort Knox IOUs. Now, this is all a narrative that has to be proven wrong because there's nothing else out there that makes sense yet, right? So there you go. That was actually connecting the dots between something Zoltan Pozar said and something Egon von Grantz said that reminded us of something that we had heard years ago. All right. Next, bullion banks with exposure and risk need to replace gold that they were using. So bullion banks have been leasing gold for years from the BIS, okay, from central banks. So when you say central banks, leasing it from central banks, think BIS. The central bank leases the gold, but the BIS is the intermediary. The BIS is the customer service representative for bullion banks in that respect. And central banks are where they source it from. So leases got called, collateral got called, China demand started pulling gold out of Europe. And so it became a little bit harder to borrow gold for leases. So you actually may have had to buy some of the gold back, depending on who you were. And that created a kind of a musical chair situation. Musical chairs in the sense that every time the music stops, let's call that stopping a moment where the price closes at a certain price, right? Every time, or an event of time goes by, every time it stops, everyone has to sit down and claim their gold in a semi true up, right? Lease rates are up, right? Well, little by little, every time the music's stopping, chairs are being taken away. There's less gold available to lease. So bullion banks had relied on a game of musical chairs, borrowing gold to meet short-term needs. But when enough chairs are removed, as the picture says, when buyers refuse to lease their holdings, that's an old-time short squeeze, banks are forced to compete for an ever-dwindling supply. That is what's happening now. And we wrote that a couple months ago. Point five was there are probably now this is completely speculation, but when you connect the dots, uh, somebody's underwater and other people are covering it up. There are probably double and triple counted gold leases sitting at central banks in Europe and maybe elsewhere. Now, uh, pick four. The EU is ideologically comfortable. Before we get into that, let me just put a little bit more meat on this. When the LBMA says, right here, when the LBMA says gold is heavy, I think I'm literally quoting them. Uh, uh, I saw the trolleys, and isn't it like when they try and make it an interest conversation about the fact that they cannot satisfy their obligations, that they cannot deliver that which it is they're supposed to deliver, then they cannot do their job. When they make it a story about, oh, this gold is heavy, or oh, it's really hard to do. Uh, that's like, that's victim signaling. Okay, that's their job. Now, when they say we're having a hard time logistically because there's so much volume and it's going to take us a couple more days, I buy that. But when they also say, out of the other side of their mouth, we're borrowing gold from the Bank of England at an increasing rate, and it's getting hard to get it. Bank of England's not as forthcoming as they had been. Well, then you got to think something's not right. And they're hoping that this goes away as they always did, like they did with the energy crisis that they had over the winter of 22. Okay, so that's the background. Somebody doesn't have the gold or doesn't have the gold unencumbered. Okay. I think Ronan Manley might have said something about not this, but he said something related about gold being double counted. So if a gold's on a balance sheet, uh, it's counted as an asset, and then if it's loaned on someone else's balance sheet, it's counted as an asset there too. So it's kind of like a daisy chain of gold. Leasing gold creates a daisy chain, which is something else that we contended. All right, so to the EU is ideologically comfortable with this, as are we. because they believe the leases will be honored when the gold is called by them. But the gold will never be called by them because they believe that gold is a pet rock, and they're right. And because all the gold on earth is available, well, they figure at some point someone will sell it. And if they don't sell it, we'll squeeze them to sell it, meaning, rates, income, it's a non-performing asset, but no one is selling it. And it's a crowded trade to be short gold, expecting people to eventually sell it to you, on a long enough timeline type of stuff. Uh, the gold will never be called by Europe from the bullion banks. Why? Because this is our opinion. Because doing that would be like revealing the emperor is naked, and so they will continue to self-delude, kick the can down the road, and hope that somewhere someone's gold will be made available to replace their lease. So I'm a central bank. I've leased gold to a bullion bank, and everybody else wants their gold. I'm a central bank. I'm going to call my gold back. If I'm the United States, I'm going to get my gold back if I'm China. If I'm in Europe, it's quite possible that I'm scared to do that because the bullion banks in Europe, or the banks in general in Europe, have so much gold leased from the central banks that the central banks really wouldn't have the gold. So it's kind of like I guess it's a Schrodinger's gold type of situation. Anyway, so that was their behavior with green energy as well. And that's point five. The new thing we want to add is all that remains from this little thing that I just put together here is an answer to why the gold is being brought back here to the US so briskly. And given the geopolitical backstop, Trump's policies geared towards resetting the economic drivers of the US and a pressing need to stem debasement by deficit, meaning the dollar going to zero because of our deficit, as opposed to being orchestrated to go down. The answer will involve harnessing gold's monetary power in some way to address these circumstances, whether it be bonds, stable coins, international mercantile money, or a type of gold standard. We will probably know after the Ukraine war ends. When that happens, money will never be the same again. The graphic you're looking at there is, well, you may not be familiar with it, but that's an eye-popping graphic. A month ago, that graphic did not have that long light blue line going up. That long light blue line going up is the U.S. pulling gold back out of Europe. Okay, so the dark blue line is the world pulling gold out of Europe, or the world repatriating gold. So this is all, in 2022, 23, 24. That's OTC gold. It's not the gold that you see in your normal charts. This is a physical market gold. So in 2025, the US enters the chat, so to speak. And now you have a situation where Europe is being depleted from the East and from move. That's an eye-popping chart, and well, eyes are popped. Moving on, market news. The market news, I'll give it to you in 4 words: recession, fusion, and stock lap dances. Fears of recession are growing and are acknowledged by Besant, which is fine. He's saying, grow up. We have to deal with it. Uh, Fusion, nuclear fusion, they're talking about again. Probably won't happen, but thorium reactors are happening. And stock lap dances. Uh, Dark pools are creating rooms within the room for exclusive conversation. Probably a champagne room with a scantily clad woman and uh, a big bouncer making sure nobody cheats too much. So that's the news there. On deck this week, it's not CPI and PPI, it's the Fed. I'll change that later on. FOMC is this week. And checking with the markets again. Oh, there's silver, right? So look, we're above this, right? We're going. I'm going to get hung for this. We're trading 33.74. We're going to $35. We'll go to we'll hit 35 before we'll hit 31. That's my bet, right? That's my trade, and my position exhibits that. And above 35, we could go to 39 relatively quickly, but I'm not gonna stick myself on the chopping block for that prediction yet. So there's gold. There's a daily gold chart, and you can see we're in rarefied air. Are we going to pause here? Are we going to drop here, or are we going to go up? Well, I don't think this is a natural pausing place for funds to liquidate. In fact, I'll show you what I'm talking about. This here, that's macro discretionary funds taking profits and bullion banks buying from them. Okay, started in this area. This here is shorts getting in and longs buying dips. See this day here? That's macro discretionary funds saying, you know what? Let's get in again. So I don't think they're getting in to sell it down here. I don't think they're getting in to buy it up here. I mean, to sell it here. I think they're getting in because they're looking for a bigger move. So if you put a gun to my head on this, I'd have to say that gold is having a little sticker shock and saying, wow, 3,000, what do we do? And everyone's kind of thinking about it. So we could be here for a while. I don't think there'll be a big dip. If there is a dip, I think it'll be bought aggressively because there's probably some options around here. People talk about options a lot at 3,000. There were a ton of options there, but they have since expired. So there wasn't a lot of gamma going into this. So I don't think we're going to be pinned because of options behavior. But I think if you're going to trade this, you should be short below Friday's low for a quick short, see how it acts if it gets down to here. And if you want to be long this, there's probably more buy stops above yesterday's high. Anyone who sold it on Friday, put a buy stop right above it. Nobody wants to be short this fucker much longer. I'm Vince. Have a great day.